Excuse me, ma'am. I'm finding it difficult to off your video.
The reason why you guys are showing us your face now is what I don't understand.
Sorry,
Can
it
you
was
mute
a
your video
mistake.
and mute your mic? Please. Esther Peter, please, can you mute your mic and cancel your video?
Yeah, hello class, good morning. Can you hear me?
Who is
Yes,
this?
we can hear you.
Can you hear you?
You all should mute your mic. Can you hear me? Hello, good morning.
We can hear you, sir.
Good morning, sir.
Please continue.
Good morning, sir.
Yeah, so today, hello. Today's topic will be on cash book. Can anybody tell me what is cash? Hello. Can you all hear me?
Yes, sir.
Cash book
We
is
can hear
a
you,
book.
please.
Is a book where
Please,
you
you
keep
can go
records
on.
of cash. For the
What?
Please, you can go on. We can hear you.
Tell me your name first before you answer the question.
okay, sir. My name is Aobajo Oluwatobi Oladele, Finance Department. Cash book is
Okay.
a book
Where
where
are
you
the class
keep records of.
Where are the class,
Sir?
where are the class governors?
I don't know. Maybe
Good
they are
morning,
available
sir.
yet, sir.
Good morning, sir.
How are you? Who is that?
This is one.
Hello,
Okay.
class. Can you mute yourself? When you are about to talk, the lecturer will call you. You are just disturbing the class. Everybody mute yourself. If you want to talk, raise up your hand. The lecturer will identify you. Please, mute yourself, everybody.
Dr. Shodeinde, please make me co-host. I can't share the screen.
Àwọn ti pé òun wọ́n mi ráìsì ṣá.
Thank you, sir.
You are one of the.
Thank you, sir. I've shared the screen. All right, thank you very much, sir. Good morning, gentlemen and ladies. The people that raised their hand, what is the issue?
We want to
Someone
answer the
raised.
question you asked us.
You asked for the class governor, sir, so I raised my hand to tell you I'm around, sir.
I want to answer the question. That's why I raised my answer.
Please bring down your hand, lower your hand, lower your hands, lower your hands. So Dr. Shodeinde was trying to keep you busy before I joined the platform. Thank you all. Please kindly mute yourself, all of you. Mute yourself. Mute yourself. So thank you very much. In the course of the lecture, in case you have any question, contribution, just raise your virtual hand or you chat through using the chat box. I will check, recognize, and ask you to speak. So unless that is done, please do not interrupt while the class is going on. Thank you very much. So good morning once again. Our lecture is okay, let me on the light. All right. Today's lecture, we are looking at principles and practice of double entry bookkeeping. So it's one of the topics assigned to me by the coordinator to teach the class. So we are going to learn in the class today. It is expected that, let me use slide show. Didn't view. Where is the slide view? Okay. Sorry. Slideshow. All right. Study objectives. At the end of the class today, it is expected that students will be able to define the principle and the basic rules of double entry principle. Students will be able to explain the nature and content of a typical ledger. And they'll be able to enumerate the rules of double entry and to explain the conventional double entry bookkeeping and accounting equation. So these are basically the objective we are going to strive to achieve today in this lecture. Shift this to the left. Okay, shift this. All right. The double entry system signifies a system of recording all transactions into two accounts. Now, the basis of double entry is that it is recognized that every transaction has two aspects. Every transaction has two aspects. Of course, to have transaction means to exchange value or goods with another party. So meaning that it always involves at least two parties. One gives, the other receives. So that is the essence of any transaction: exchange of goods and services, exchange of value. So the system of recording transaction in which each of these aspects of the transaction are well noted in the books of account is called double entry system. So it signifies a system of recording transaction into books of account. It explains the principle of duality. If you remember while we were discussing accounting concept, we discussed duality concept or dual aspect concept, which states that every transaction affects two accounts. So at least every transaction will affect two accounts: the account of the receiver, the account of the giver, at least. There could be some transaction that will affect more than two accounts, but at least two accounts will be involved. So where transactions are recorded in the books of the first party and the second party together, it is what we call double entry system. It is achieved through double entry principle. Don't know how does this thing work. Okay. So the double entry principle simply states that for every debit entry, there must be a corresponding credit entry. And for every credit entry, there must be a corresponding debit entry. In other words, for every recording of transaction in the book of the receiver, there must be corresponding entry in the book of the giver. So as you record the aspect of the giver, you record the aspect of the receiver. So in accounting, we use the word debit and credit. Just like plus or minus in mathematics, we use the principle of debit and credit to capture each of the aspects of the transaction. So the straightforward principle of double entry states for every debit entry, there must be a corresponding credit entry. So for instance, if Ade purchased motor vehicle, 5 million naira, paying by cash, 5 million naira paying by cash. So in the book of Ade in this sense is a business. Let's say Ade Enterprises. So in the book of Ade Enterprises, transaction has occurred which involves spending of cash given by Ade Enterprises and receiving of motor vehicle from whoever is the vendor. So the giver is Ade, the giver of cash is Ade, and Ade Enterprises receives motor vehicle in return. Receives motor vehicle in return. This online program receives motor vehicle in return. So this is the giver and this is the receiver, where transactions are recorded to capture in the account of Ade, which is the motor vehicle received, and the other account that gives, which is the cash. So we debit equipment, the motor vehicle, we credit the cash. Cash gives out, cash account gives out, motor vehicle account receives value. So when transactions are recorded in this form, we call it double entry system. It is only when you record on double entry basis that book of account will agree at the end of the day. If only an aspect, say for instance, aspect of the giving is what is recorded, then the book of account will have been recorded on single entry basis. If time permits, and if that is part of our syllabus, we'll look at single entry system. But in this case, we are discussing double entry system. What is the implication of this principle of double entry? The implication is that for any transaction, at least two parties will be involved, the giver and the receiver. So anytime there is a transaction, your first point of duty is to look for who gives and who receives. Who gives and who receives. So this, once you are able to identify this, then recording the transaction on double entry basis will be easier. The other implication is that an account will be open for each aspect of every transaction. So the aspect of giving, just like the example I gave, cash account gives 5 million. So we open an account called cash account in the book of Ade Enterprises. Then the receiver too, which is the motor vehicle. Motor vehicle account receives a value. We open account of motor vehicle in the book of Ade Enterprise. So we open account for each of these aspects. The amount of the transaction is posted to the debit side of one account and to the credit side of another account, following double entry principle. So in the case of this example now, it means since something gives and another thing receives, cash is going out of cash account. So the account will be credited. An amount value is coming into motor vehicle account, the account will be debited. So you could see that the same transaction has been recorded in two different accounts, motor vehicle account and cash account. One of the accounts has been debited, the other account has been credited. Doing this, you have observed the principle of double entry. So as a summary, following the basic rule of double entry, debit the receiver of money, goods, or services. So once you are able to identify the receiver and the giver, so applying the golden rule of double entry means that you debit the receiver. Whoever receives will be debited. And whoever gives will be credited. So you credit the giver of money, goods, or services. So in the example I've mentioned, excuse me, in the example I've given before, it means motor vehicle account, which is a form of goods now, has received a value, or a form of, it has received a value in terms of money, 5 million naira. So we open that motor vehicle account and debit the account with 5 million naira because that is the receiving account. We credit the cash account because it is from the cash account we took the money, 5 million naira, to pay for the vehicle. So we credit cash account because the account gives. So this is how you apply the basic rule of double entry. So let me give this example. Assuming ABC Enterprise paid for goods bought on credit from XYZ, 20,000 naira cash. ABC Enterprises paid for goods purchased on credit from XYZ Limited, 20,000 naira. Who can identify the receiver and the giver? We want to record this transaction in the book of ABC Enterprises. Always take note, when you have a transaction, be sure from which perspective are you recording the transaction, because recording in one business will be different from recording in another business for the same transaction. So in this case, ABC Limited, ABC Enterprise is our business. So this business paid 20,000 naira cash for goods purchased on credit from XYZ Limited. It has purchased the good before, now paid 20,000 naira cash. Who is the receiver and who is the giver in the book of ABC Limited? Olakunle Sowemima. Olakunle Sowemima. Olakunle, you raised your
Good
hand.
morning. Good
Yeah.
morning, sir.
Good morning.
Yeah. So in the question you asked now, the debit is the ABC, and the because they are giving out the cash, and the receiver.
Hello. The question is, who is the receiver? Who is the giver? Don't debit, don't credit. Just tell us the giver, tell us the receiver. Simple.
Okay, the debit is ABC, and the receiver is XYZ.
The giver is who?
The giver, which is the receiver, is
Alakunle,
ABC.
let's allow, because of our time, let's allow Oluwasegun Thomas. Oluwasegun Thomas.
Hello, sir.
In the example given, who is the giver? Who is the receiver? Remember, we are recording in the book of ABC Enterprises.
Okay, the giver is the XYZ, while the receiver is the ABC.
Your answer is not addressing my question.
I want to answer.
Okay, go ahead.
Okay. ABC is the giver, while XYZ is the receiver.
Listen to the question again. I said, anytime you have question or a transaction, identify which company or which business is treating that transaction. And I said, in this case, ABC Enterprises is the one that conducted this transaction with XYZ. ABC paid 20,000 naira cash to XYZ Limited, having purchased goods on credit before from that company. Now, that transaction of purchase of goods on credit, 20,000 naira, record the transaction in the book of ABC Limited or Enterprise. So in the book of ABC Enterprise, which account gives, which account receives? That is the question I ask. Ajibade.
Let me answer.
Go ahead.
Okay, this is Ajibade Motayo. So the ABC is the receiver, why XYZ is the giver?
Well, none of you get the answer correct because you have not listened to the instruction. And that is very important when you are
Good morning, sir.
answering question in accounting. I have told you the first thing to do is the transaction belongs to who? That should be the first question. And I said ABC Enterprises. So in the book of ABC Enterprises, I want to record this transaction of payment for goods bought on credit, 20,000 naira cash. So in the book of ABC Enterprises, there is purchases account. There is purchases account, right? In the books of ABC Enterprises, there is cash account. In the book of ABC Enterprises, there is XYZ account. XYZ account being the payables because the goods were bought before on credit. The goods were bought on credit. So there is an account for XYZ in ABC. That account of XYZ in ABC is what is receiving now. It's receiving a value of 20,000 naira. The cash account of ABC is the one giving 20,000 naira. So for the principle of double entry here, it means cash account of ABC gives 20,000 naira. It is the giver. Then XYZ account in the book of ABC receives a value of 20,000 naira. Then it is the receiver. So by applying the double entry principle, we debit the receiver, which is XYZ account, and we credit cash account in the book of ABC Enterprise. However, if the same transaction were to be treated by XYZ Limited, the recording will be different. Because in the book of XYZ, XYZ will have ABC as a receivable. Therefore, cash account of XYZ receives 20,000 naira, so that account will be debited. Whereas the account of ABC Enterprises in the book of XYZ will be the given account, so that account will be credited with 20,000 naira. So this is how always understand which business is treating the transaction. In which book are you treating the transaction? So this is basically the principle of double entry and its application. Because of our time, you may lower your hands, please. Now, the ledger. Kindly lower your hand except you have question. Udofia, is this a question? Okay, thank you. So, the ledger. Ledger is the principal book of account where double entry principle is completed. So every business has a ledger, which is the main book of account. And it is in the ledger that you complete double entry. We have to state this fact because there are some other books called subsidiary books, which are designed to decongest entries into the ledger. Recording in those books are not on double entry basis. It is only in the ledger that transactions are recorded on double entry basis. Ledger contains various accounts which are part of the double entry. So in the ledger, you have several accounts. And those accounts are part of double entry. Once you debit one account, you have to credit another to complete the double entry recording. Each of these accounts is divided into two parts. So an account has two parts, a debit side and credit side. Debit side of any account is always at the left-hand side. So it's like when you have a big T, a capital letter T, to your left-hand side is called debit side, and to your right-hand side is called credit side. Okay, so this is an account like now. This is an account. So this is an example of an account. To the left-hand side is debit side. To the right-hand side is credit side. So this is what we call an account. Now, Content of a ledger, of any ledger account, include the date column. So because transaction will always occur on a particular day, so there must be need for the date. It is to monitor where and when transaction has been conducted. And it is, you can use it for so many purposes later, the audit trail and some other things like that. So the date in which the transaction took place and in which the transaction is recorded in the account. The details, which is a brief description of the transaction itself, e.g. purchases, that's the description, sales, receivables. So this will be the description you put under this column. There is a column for folio, which indicates the summary. In summary, the page on which the corresponding entry or source of transaction can be found. Then there is an amount, the column for an amount, which is where you record the value of the transaction in monetary term. So this thing is always. So for instance, this is an account. This is a ledger account, cash account. This is the date, the description. You put the date when you are recording the transaction or when the transaction takes place and you are recording it. The description, brief explanation of what the transaction is all about, e.g. purchases. Ledger folio, the amount. So this is for the left hand side, which is debit side. So you do the same thing for the right hand side, which is the credit side. So this is how an account will look like. Okay. Now, as part of the objective of the class, we say you also understand the accounting equation, especially as it relates to double entry recording. The basic accounting equation, which must have been taught at the introductory class level, is asset equals to capital or equity plus liability. So it is regarded that every business has resources which it owns and control, and which is using to generate further resources into the same business. At the other side, a business has liability, obligations that must be repaid, because the business itself cannot provide everything it needs to carry on the operation of the business smoothly. So there may be need to source for resources outside. Those resources sought outside will have to be paid back, and they are called liability. These resources sought outside are divided into two. One are the ones provided by the owner of the business, which is captured by capital account or called equity account. The other one are those ones that are sought outside the business again, which is not that of the owner. So they are called liability, such as the payables when you buy goods on credit from your supplier, when you get loan from banks, and some other things like that. So each of these, to increase each of these items, for instance, if something is a credit balance, to increase such credit account, you have to credit to it. So that's why we said credit plus credit. If account is a debit balance account, for you to increase it, you have to make a debit entry to it. That's why we say debit plus debit. But to decrease an item, each of these items of assets, capital, or liability, if that account or item is a credit balance and you want to decrease it, you have to make a debit entry to it. For instance, cash account is an asset account and it has debit balance. It has debit balance. So say 50,000 naira. For me to reduce that account, then I'll have to make a credit entry. In account, you don't go back to that and deduct the figure. No. Rather, you make corresponding entry. So if an account has a debit balance and it has to be reduced, just make a credit entry to it by recording at the right hand side of the account, and the value in that account will reduce. If an account has a credit balance and you want to reduce that account, you just make a debit entry to it at the left hand side of the account, then the account will reduce. Conversely, if you want to increase the value in an account, which is a debit balance account, then you make another debit entry. If you want to increase the value in an account that has credit balance, then you have to make another credit entry into that account. So this is how you increase or reduce the value in any of these accounts following the principle of double entry. Note that owner's equity or capital and liability takes the same nature of entry in the books of account because owners funds from one entity, from our entity concept, form part of liability of the business. I just explained that owner equity or capital is also a liability, except that it comes from within the business, which is the owner, while others come from outside the business. To help us understand what we have discussed, I have this table. So in the accounting equation that I just shown us, asset equals to equity plus liability, we have asset. Asset has debit as normal balance. To increase such account, you debit, and to reduce it, you make a credit entry. Equity, liability, income, expense. All these are items in the financial statement. We call them elements of financial statement. Elements of financial statement. So, ledger that we are discussing can be divided into two major types: personal ledger and impersonal ledger. The main book of account could be divided into personal and impersonal. For personal ledger, it contains account in the name of persons, organizations, firms, etc. So this personal ledger could be divided into 2 or 3. Sales or receivable ledger, which contains accounts of people that purchase goods from business, especially if it's on credit. If it's on credit, so it contains account of credit customers to whom services have been rendered. Purchases or payable ledger contains account of credit suppliers, those people the company bought goods from or that render services to the company. Then the private ledger contains the account of the business owner, which is the capital, drawings, and so on. The other one is impersonal ledger. Impersonal ledger contains accounts other than those in the name of people or organization, and is divided into real ledger or nominal ledger. The real ledger contains accounts for things that could be seen, touched, and moved. So like motor vehicle, furniture, fittings, land and buildings, they are real because we can see them. Inventory, and so forth. Even cash, because we can see cash, touch it, and move it. While the general or nominal ledger contains other accounts that cannot be found in other ledgers, especially account of income, expenditure, gains, for instance, salary, for instance, rent, electricity. These are accounts in form of a nominal account, and they will be contained in the ledger. Now, we have discussed the ledger. Then, in the ledger, there are accounts in the ledger. So the classification of the account in the ledger follows the same classification as the ledger. So, and that account is more or less a kind of space or a page in the ledger, which is used to record individual transaction that is peculiar to that account. So you find some of the definition of the account here. So that classification of account follows the same classification of ledger. So it means we have personal account. Personal account relates to account of persons and organizations that the company transact with, such as receivable account and payables account. So receivables account means accounts of credit customers. Just like receivable ledger contains accounts of, or a ledger devoted for accounts of credit customers. Also, we have payables accounts, which are accounts for the people that the business owes some obligation to pay back to. So then there is nominal account. Just like we have nominal ledger, there is nominal account, which records income and expenditure of the business. And the real accounts, which are accounts of company's property, things that could be seen, and so forth like that. I'm moving forward because we have some illustration we need to do. Now, This is how we prepare account like we have illustrated before. Date, particulars, folio, amount. For the left-hand side, which is debit side, date, particular, folio, amount. For, you can call it particulars or you call it description, the one we used before. So for instance, an asset account, like the explanation of using our accounting equation that we stated before. So this is an asset account. An asset account is debited for increases, always credited with decreases. So the above means that when assets increase in value, either by buying it in cash or on credit, the account should be debited with increase. So whenever you buy more assets, you debit the account because it has increased in value, either in cash or on credit. Then you credit asset account for reduction, such as when you dispose part of the non-current asset. When you dispose part of the asset, you make a credit entry. As for liability, liability increases by making a credit entry to it. For instance, if you buy more goods on credit, it means your liability has increased. Then you make a credit entry to the payables account. But if you make payment, you are owing somebody 50,000 naira before and you pay 20,000 naira. That's a reduction. It means the amount you are owing now has reduced to 30,000. So you make a debit entry to that account to reduce the value. Expenses. Expenses shares the same recording as asset. So if you pay more salaries, then salary account will be debited because you have paid more. If you paid more for electricity, you make debit entry to that account because you have paid more. But if value in the expense account needs to be reduced, then you make a credit entry to that. Say, for instance, you pay 50,000 naira and it was discovered that no, you are supposed to pay 40,000 naira. So the difference of 10,000 naira will be credited to the account so that it will reduce the value from 50 to 40,000 naira. So income account like sales, when you make sales, you'll have debited the receivable or debit cash, then you make credit entry to income because income has a credit balance, and for it to increase, there must be a credit entry into that account. So illustration, a company bought a van by cash, 1 million naira. So following the principle of double entry, let us see how we record this transaction. A company bought a van by cash, 1 million naira. So in this now, it means in this transaction, the two accounts involved are van account and cash account. Van account and cash account. So when you open the account, you open van account. Because van account is the receiving account now, assuming that company has a van with a total of 2 million naira before, and now they purchase another one for 1 million. 1 million will increase 2 million to 3 million. So that account receives value of 1 million naira with debit van account. But because we have paid for it in cash, the corresponding entry will be a credit entry, which will go to cash account because we took the money to buy the van from cash account. So always note that when transaction is conducted, it has to do with a business. You identify that business has account for everything it is doing. If it pays for electricity, there should be electricity account in that business. If the payment is by check, it means that business has bank account. So everything comes back to the business, except where otherwise stated or required. You don't record cross business. You record in the same business. But some questions may ask you to treat a transaction in the book of account of the two businesses involved. So if that is the case, it means you record in this account, you also go back to this one and record there. But it's rare to always to see that. Another illustration, assuming a firm purchased an equipment by cash on August for 50,000 naira. To record this transaction, we identify the two accounts in the business that will be involved. So obviously equipment account is involved, and the means of payment is cash. So cash is involved. Now equipment account received value of 50,000 naira, so it is the receiver, and we debit the receiver. Look at the date, August 30. Look at the description, which is cash. We didn't include folio to make it simple. Then this is the amount, 50,000 naira. And we have recorded it at the debit side of the equipment account. Corresponding credit entry to complete the double entry, we move to cash account. This is the date, the same date, equipment. Now look at it. When you record in the equipment, what did you call it? You say cash. It means that when you are recording in one account, you have to tell us in that account the value you are going to record, where is it going or where is it coming from. Now, I'm recording an equipment account. I'm recording 50,000 naira. This 50,000 naira is from which account? I say it's from cash. So this will immediately tell you that you need to make a corresponding credit entry in the cash account. So this is the meaning of correspondence. It means equipment account is corresponding with cash account. They are exchanging information. That's the meaning of correspondence. So when you come to cash account, so I am recording 50,000 naira in cash account. Why am I recording such? It is because I have purchased equipment. So I put equipment as description or particulars. So this is how, illustration 3, a businesswoman sold goods worth 20,000 naira in cash. So sales of goods. It means in this, sales account is involved, cash account is involved. Sales account is involved, cash account is involved. Now, because you sold goods, you have disposed what you are selling in your organization. So goods are going out, or value is going out of your organization. That means sales account is the giver. And you know, we always credit the giver. You receive 20,000 naira by selling these goods. Cash is coming back to the business. So it means cash account is the receiver. So we debit the receiver 20,000 naira from sales. We'll go to sales account. We say we credit it with 20,000 naira coming from cash account. So this is how the first duty is to identify which account is the giver account or giving account and which account is the receiving account. Once you identify this, recording transaction on double entry basis becomes easier because you know the rule. The rule is debit the receiver, credit the giver. So ensure that you first of all identify who the giver is and who the receiver is. So that will be the starting point. And once you are able to do that, recording transaction on double entry basis becomes easier. All right. Now let's look at this long exercise. Exercise 1. So I'm going to ask us questions, even though the solution has been provided, but we'll still ask questions to know. Let me check. They say you should not write names here. You don't have to. Okay. On January 1, Grace defined commenced business and introduced cash of 20,000 naira. You can see series of transactions. So before I move to solution, I'll be asking us questions now. Now, in this first transaction, Grace defined commenced business. So that is the name of the business now. Grace defined commenced business and introduced cash of 20,000 naira. So what are the accounts involved? If you know it, just raise your hand. In this transaction of January 1, Alexander, go ahead. Alexander. Alexander. Let's move to Clinton. Peace Clinton. Alexander is not talking. Peace Clinton.
Okay, sir. So Grace
Divine account, commodities and account. That's capital.
Okay.
That's capital.
Which
Under
other account?
the other account will be cash account,
Cash account.
20,000.
Thank you very much. So in this transaction, Grace Defined is the owner of the business, is the person that introduced the amount. So we treated that, we treat that one as capital or equity. So that account will be affected. Then the cash account will be affected. So which of these two accounts will be debited? Which of them will be credited? Nelson.
Debited, you will debit capital account, credit cash account.
Why? Why should we do that? Nelson, you said we should debit capital and credit cash. I said, why should we do that? You need to identify which of the two accounts gives and which one receives. So obviously, in this transaction, somebody introduced cash. It means cash is giving. Cash is receiving. Cash account is receiving the value of 20,000 because somebody gave that cash. So the amount is coming into the business. So cash account receives. Whereas capital account is the giver account because the owner of the business gives the business. So that capital account will be the one to be credited. So we'll debit cash and credit capital account. The second illustration, January 2nd, purchases were made for cash, 5,000 naira. Tolulope Adeleke.
Good morning, sir. Purchases was made for cash. That means our cash accounts will be credited while the purchase account will be debited.
No. Purchase account can
You see,
never.
hello. Always listen to my question. One, always answer the question that is asked. Okay? It is the question I asked that you should address. I'm treating each of these transactions in 3 steps. 1, to first of all identify the 2 accounts. Every transaction will affect 2 accounts. So you must tell me first which are the 2 accounts that will be involved. The next question that I will ask will be that you tell us which of the 2 accounts gives, which of them receives. Then the third one is now which of them is to be debited and credited. So stick to the question, please.
Hello, sir. Good morning, sir.
Yeah, who is speaking?
Good morning, sir.
Yeah, good morning.
The 2 accounts is purchases account and cash account.
The 2 accounts are purchases account and cash account. Thank you very much. So let's look, Mr. or Mrs. Atim? Now, which of them gives, which of them receives?
Purchase account is the giver, while the cash account is the receiver.
Purchases account is the giver?
Yes, sir.
Cash account the receiver?
Yes, sir.
I'm not sure that is correct.
Sir, let me answer. Purchases account is the receiver because they buy something, they purchase something, while the cash is the giver.
Yes, purchases account receives. This business, Grace Defined, purchase some goods. So those goods are coming into the business. And the business now made payment of 5,000 naira for that. It means 5,000 naira is leaving the organization. So purchases account is the receiver, cash account is the giver. So by a simple principle of double entry, you debit purchases and credit cash. The third transaction, cash sales amounts to 4,000 naira. Olabowale Oluwatomisin. Yep. The 2 accounts involved in transaction 3 is what? Or are what? And what? Lawal Rodiat.
Good morning,
What
sir.
are the 2 accounts involved in transaction 3?
We are going to have the cash account and the sales account.
cash account, and sales account. Thank you. Happiness. Which of these accounts gives? Which of it receives? Waiting. Happiness. Between cash and sales, which of them gives? Which of them receives? Happiness is not ready. Let's look for Adesanya Gbemisola. Adesanya. Which of them receives? Which of them gives? Adesanya, you are not following us. Okay.
Hello, sir.
I look for, yep.
Sales is giving, cash is receiving.
Cash account receives 4,000, sales account gives value of 4,000. So by a simple principle of double entry, we debit cash, we credit sales. Okay. Transaction 4, which is also on January 3. Paid cash into bank, 22,000 naira. Paid cash into bank. Henry Okonko. What are the two accounts involved? Henry. Yep. Yep.
Cash account and bank account.
Cash account and bank account. Great. Grace Azubuke. Now, Grace Azubuke. Which of these accounts gives and which of them receives? Paid cash into bank, 22,000 naira.
Cash account receives, paid cash into bank. Bank account receives, cash gives, because you're paying the cash into the bank.
Yes, thank you very much. In this transaction, bank account receives 22,000 naira. Cash gives 22,000 naira. So it means by simple entry, double entry rule, we debit bank and credit cash. Now, this type of transaction is usually called contra entry transaction. Contra entry transaction. A transaction that does not involve third party. It begins and ends in the business. You will discover it is the same Grace defined business that paid the cash of 22,000 into its own bank account. So we call this type of transaction contra entry transaction. In the column of ledger folio, we include capital letter C to show that this type of transaction is contra entry. Okay, let's proceed. When we will get to the recording, we'll see it. The next one, January 4, wages paid in cash, 1,000 naira. Wages paid in cash, 1,000. What are the two accounts involved? Iwegbuna, Chukwemeka Clement.
Wages and cash account.
Wages and cash account. So, Titilayo Faith, which of these accounts receives, which of them gives? Titilayo.
Yes, sir.
Yeah. Which of the accounts? Wages paid in cash. Cash account and wages account involved. Which of them gives, which of them receives?
Okay, the wages account receives, while the cash account gives.
Cash account gives. Because it is 1,000 naira cash that is used to pay the wages. So wages account received 1,000, cash account gives 1,000 naira. January 5, paid for shop premise by check, 1,600 naira. Onasanya Rahmat. What are the two accounts involved in this transaction? Onasanya. She's busy. Let's look for Samson. Samson Ihiale, right? I hope I pronounce it well.
Yes, sir. Yes, sir. It's premises account and bank account.
So bank account, because the transaction was conducted using check. and the premises account, because shop premise were paid for shop premise. You know, this could be tantamount to rent, right? This could be tantamount to rent. He said he paid for shop premise. It could be tantamount to rent. So most likely it will be rent. I guess that's what that will be the intention of the writer of this question. So that should be rent. So rent account and bank account. Because it was paid for by check, it means bank account is given out, while this shop premise, or otherwise known as rent, is receiving. So we debit the shop premises or rent, we credit bank account. Let's be fast. January 6, paid for office equipment. This is office equipment by check, 14,000 naira. Mercy, Obayuana. What are the two accounts involved?
Office
Paid for
equipment.
office equipment by check.
Office equipment and bank.
We can't hear you.
Office equipment and bank.
Bank account and office equipment account. So now here, which of these accounts gives, which of them receives?
Office equipment is given, bank account.
Office equipment received, bank account gives. So that means we are going to debit office equipment and credit bank account. The second to the last, sold goods for cash, which is almost the same thing as January 3, right? So cash account and sales account. So we debit cash, we credit sales, because sales account gives, cash account receives. The last one, paid for fixtures by cash, similar to January 5 and January 6. It means fixtures account and cash account are involved. So we debit fixtures, we credit cash. So let us look at the solution to that. So we have prepared this column, this two-column cash book. I don't know if you have been taught cash book before. So this is two-column cash book. We prepare two-column cash book because some of these transactions involve cash, some of them involve check, which is bank account. So where a cash book has a column each for cash and bank, we say it is double column cash book. Okay, so if anything affects cash, we record under cash column. If anything affects bank, we record under bank column. Instead of opening cash account separate and bank account separate, we combine the two in one cash book. We call that cash book double column cash book. So you could see the first transaction, debit cash. We have debited cash, 20,000 will credit equity. Transaction of January 3rd, we debit cash, we credit sales, 4,000. Transaction of January 3rd, the one that paid cash into bank. So look at it, we debit bank, then you come to the other side of the cash book, you credit, you see January 3rd, 1, okay? Bank, 22,000. We took this money from cash and we give it to bank. So we indicate that this is a contra entry transaction by including a letter C in the folio column. Or if you don't prepare folio column, just put letter C in bracket in front of this cash. Then January 7, sales of goods for 20,000 naira cash, paid for wages, purchases, wages, premises, okay, equipment, fixtures. So all this. So when you do this, you must balance an account. So we balance this account by comparing entries at the debit side, cash column, entries debit side, bank column, against entries, credit side, cash column, credit side, bank column. So when you look at it, the total value of figures here, 2020, this is 44,000, is higher than what is here. You see 5,000, 22, 1, 1. So these are the only transactions here. This is 26, 27. So 27 credit side, 44 debit side. It means debit side is higher than credit side with 15,000 naira. We balance it. If you consider the bank column, we have 22,000 naira at the debit side, but at the credit side, where is this thing going? At the credit side, we have 16 and 14, which is 15,600. So debit side is higher than credit side. So we balance the account as the case may be. So we now record each of those transactions. We take them to the ledger account to effect the corresponding entry. Look at equity account. We have debited cash, we credit equity. Look at sales account. We have debited cash twice. Look at purchases account, wages account, premises account. So this is how you effect double entry recording for each of the, look at fixtures, equipment. So this is how you record each of the transactions on double entry basis. Okay. Oh, I think our time is fast spent. Is it time already? So let's look at this. Governor, inform me when it is time to stop. Now, let's look at this.
We have 4 minutes to the end of the class. 4 minutes.
4?
Yes.
Okay. All right, sir. So I would rather leave the 4 minutes for question and answer. So let's use the 4 minutes for question and answer. So students, if you have questions based on what we have done so far, so it's only this, you can take picture of this question, you practice it by yourself. Let me change it to slideshow. So this is the last question also, last illustration. So you can ask your question, raise your hand if you want to ask question. We can, or you have any comments? Yep.
Hello, sir. I just want to ask if we get the module on this topic so that we can work on it.
Okay, the module, let me check the module. Double entry principle is study session 3. Study session 3. We start from page 27. Do you get it?
Yes, sir.
Study session 3. We start from page 27. Kenny. Kenny. Hello, mute yourself. I only recognize Kenny now to ask questions.
Sir, good morning, sir.
Yeah, good morning.
Sir, so concerning the question you gave, the question we just solved now.
Yep.
I was having difficulties with some questions. Sir, please, can you go back to the question so I can...
That's what I'm doing.
Okay, sir. Thank you very much, sir. So, this January 6 paid office equipment by cash. Is it
paid for office equipment by check?
Yes, by check. Sorry, sir, by check. So I know this check is bank, but this office equipment is still confusing.
Office equipment is an asset, just like the computer you are using in the office is an asset of the business.
Okay, sir. So on our ledger, because we are required to open a necessary ledger account. On our ledger, yes, sir. On our ledger, where are we going to post it on?
Office equipment account. Office equipment, there is an account for that. I will show you now. I've opened it here. This is equity, premises. See, this is office equipment account.
Okay.
Can you see it? So equipment account.
Yes, sir.
So this is how you do it.
Okay, sir. Thank you very much, sir.
You're welcome. Which other? Okay, let me see.
Sir.
Good morning.
Good morning, sir. Please, I want to ask if you are going to send the slide to us. This is Ruth Olopade.
Let the governor communicate me after the class. I will send to the governor so that governor will send to all of you.
Sir, please.
Good morning, sir. Good morning, sir. I have a question.
I have not recognized you. You should wait for me to recognize you now.
Okay, sorry. Please.
Go ahead.
Thank you so much
sir.
for
Thank
the
you,
class.
Sir.
Thank you. We appreciate your time. This is a very good class. This is a very good lecture you have delivered. Time is 1 hour and it has been spent. So, class, I hope you enjoyed the class. We'll continue from that next time.
Yes, sir.
So thank you, everybody. So we'll meet in the next physical class. So thank you very much, everybody.
Thank you, sir.
Thank you very much, sir.
Thank you all.
Thank
All
you.
right.
Have a nice day, sir.
And
Have a nice day, sir.
Very good
Yeah.
teaching.
We enjoy